The goal of every entrepreneur is to keep making money, to keep being in business. So whenever we talk about business, we talk about money, and whenever we talk money, we talk business. Hello, my name is Jeff Care, and today we are going to be talking about how to finance your business. So as earlier mentioned, business is all about money and money is all about business. So there are several reasons, or rather there are various reasons as to why as an entrepreneur you'd want to reinvest money into your business. And I'm talking about businesses that are already on their feet and operating. Could be sole proprietorship, could be partnership, could be a limited liability company, or whichever kind of business form that you operate. Now, there are several reasons as to why, as a business or an entrepreneur, you'd want to reinvest money into your business. So just to mention but a few, I would say number one, probably you want to expand as a business. You want to acquire a new property. You want to acquire a new premise. You want generally to expand your business. You'll require finances. Number two, I would say probably you want to introduce a new product or service. You will require money to finance that. Number three, I would say probably you want to invest in marketing and push your brand as a business, or push your services as what you stand for pertaining your business. You'll require money to do so. I would say there are three main categories that we look at as pertaining financing your business. Number one, we look at what we call asset financing. Number two, we look at warehouse financing. And then the third one, we look at inventory financing. So for today's video, we're going to be focusing on asset financing. And to kick us off, I would love to say that about asset financing, as the name suggests, asset is what you or your business owns. Basically, it's just a property, some form of property, either owned by you or your business. So with asset financing, basically is when your business uses your balance sheet as a business to obtain a loan. So what is a balance sheet? A balance sheet is generally a document that displays the assets and liabilities that are owned by your business. So because you will need access to huge amounts of loans, especially if you are operating a company as compared to a sole proprietorship or a partnership, you will require access to a lot of funds and a lot of huge loans. So because of that, you will need some form of collateral and security, because that is what your financial institutions or your borrowers will ask for before you are given the loans. Under asset financing, we are going to be looking at two main subcategories, and these are asset financing and asset-based financing. So what is asset financing as a subcategory? So asset financing, as earlier explained, is when you or your business uses some form of asset in form of collateral to acquire some financial assistance from a bank or any other financial institution, so that in case you default or you delay in payment or you fail to pay this loan, there is some form of collateral or security that your financial institution has on hold for them to safeguard this loan that you're going to ask for your business, to reinvest into your business. And these are basically short-term loans that you go for from your financial institution or banks or whatsoever where you lend your money, and you want some quick cash to reinvest into your business on a short-term basis. Asset financing is not used into business to invest for the purchases of assets and things that will take time before the loan matures. So these are loans that you go for just to settle short-term issues in your business. Maybe you want to pay your employees, or you want to purchase raw materials so that you can keep your business running. They're the kinds of loans that you require in your business for it to function on a daily basis. So these are not long-term loans that you go to borrow to purchase assets for your business or assets for yourself as an entrepreneur. Preferably, these are the most common types of loans, because by the mere fact that there is some form of some level of security attached to it, in that you're giving some form of collateral before you're given these loans, they're the most preferred by businessmen and businesswomen out there, or by businesses out there, because they have low interest rates. The second thing I would love to mention about asset financing is the fact that your financial lender will consider more the value of the property before giving you a loan. As a financial institution, I would love to consider the value of the asset that you're coming to pledge as collateral before I give you my loan. So if you're coming to borrow, say, a loan of 5 million shillings, I will consider the value of the asset that you're coming to pledge as collateral, whether it amounts to around the figure that you're coming to borrow. So that's it with asset financing. Then we have asset-based financing. So with asset-based financing, there is necessarily no form of collateral that you give in exchange for the loan. But what happens here is that if you're coming to borrow a loan, say to purchase business land, you want to maybe expand your business or something of that sort. So the property that you're coming to apply the loan for serves as the collateral for that loan. In this case, if you're coming to apply a loan to purchase business land, that land is what acts as collateral for that loan. So essentially, if you fail or you default the loan after you've purchased the land, the bank or the financial institution that you borrowed the loan from will come and repossess the land, sell it, and recover its money. So the main difference between asset financing and asset-based financing is the fact that with asset financing, there is some form of collateral that you're giving in exchange for the loan. So prior to the loan, you must submit some form of collateral. But with asset-based finance or asset-based financing, the asset that you're coming to apply the loan for is what serves as your collateral. So those are the two main categories of asset financing, and that is how they differ. Since we have talked about loans, let's look at secured and unsecured loans. So at this point, secured loans, think about them with the same perception that I think about asset financing. So secured loans are technically loans that have some form of security attached to them, either as a business or separately as an entrepreneur. So if at all you're applying a loan that you have to give some form of collateral or security before you are given the loan, then that is what we call a secured loan. And then another thing about secured loans is the fact that your financial institution will consider the value of the asset that you're coming to pledge before granting you the loan. So if you're coming to pledge a loan, or rather to apply a loan of, say, 5 million shillings, as a financial institution, I would expect you to come and pledge or rather submit collateral that is close to or equivalent to the same amount that you're coming to apply. And then about unsecured loans are direct opposite of what secured loans are. So these are loans that don't necessarily have collateral in any way. So what happens with unsecured loans, the financial institution that you are going to apply the loan from will consider the creditworthiness of your business before granting you the loan. This means that I don't necessarily need to have collateral to apply for this kind of loan. The financial institution depend so much on your creditworthiness as a business, because they look and evaluate your business in a way that if I grant this business a loan, then there is a slim chance that my money is going to disappear into thin air or be put into bad use. These are businesses that are already established and have a good track record in the market that they operate in. So that way, financial institutions have a lot of trust in your business and have a lot of belief in what you do as a business. So they don't feel in any way skeptical about offering you a loan, because they know eventually you're going to pay back the loan because your business is doing good. Your business has a good track record. So that's it about how to finance your business. I hope you learned something new. If you did, make sure to like, comment, and subscribe.